Good morning, everybody, and good evening if you're joining us from Asia. My name is Marc von Grundherr. I'm a director of benham&reeves, and I'm based here in London. I've been in property for the last 25 years, and I hope today is going to be a helpful and useful, lively debate about the property market. We're going to start now. We've got a lot of people still joining, but I think we better start because it's after 10 and we've only got an hour. We've got an amazing, illustrious panel today. I'm joined by David Cox, who's a trained barrister. He called to the bar in 2006. Today, he's the Legal and Compliance Director of the UK's largest portal, Rightmove. He started there a couple of years ago, and before that, for 7 years before that, he was actually running the property industry's professional body, Property Marc. You know, and I think we'll all agree that David's a great person to have on the panel because he's got extensive experience in political lobbying and he's had lots of successes. Next with us is our resident tax expert, Chris Bailey. He's a director of Less Tax for Landlords. So it's really good to have Chris with us because there's always loads of tax questions. As well as being an accountant, he's also a landlord with over 30 properties. So I think he knows a thing or two about advising landlords the best way to structure any purchase or how to save tax. And next with us is Conor Murphy. He's the CEO of Capricorn Financial, which is London's largest independently owned mortgage broker. They handle over £2 billion worth of lending in 2020. So I think he knows a thing or two about lending. And again, a lot of investors and owners equally are interested in that. And last but not by no means least is Vanessa Warwick, who's one of the UK's most well-known property commentators. She runs the landlord advice website Property Tribes. And importantly, like the rest of us, she's been a landlord and since 2004 and co-founded, as I said, the property investor community Property Tribes back in 2019. I think Vanessa has a finger on the pulse of all the issues and pain points that affect landlords. So the format today is literally, so welcome everybody, thank you for joining. So the format today is we're literally going to answer questions. So if anybody's got any questions, we're going to try to answer some of the ones that were asked before. And if you've got any questions, please use the Q&A function and I'll try to get around as many as we can. So thank you everybody for joining. And I think the question that everybody's been asking is, are we heading for a housing market crash? So let's start with David, because I see him smile, so he's got a good answer for that.
Yeah, I seem to get that question quite a lot nowadays. And I'm sure we've all seen the doom and gloom mongers that have been out in the press recently saying, oh, it's a massive housing bubble. It's going to burst sooner or later. Well, maybe. Yeah, it's a crystal ball. But I have to say the stats from our traffic coming to Rightmove aren't really suggesting that. Just to give you an idea, prices up nationwide on house sales 9.9% on this point last year, 6.1% in London at just over £650,000 for the average home in London. Rent, it's up 15% in London, 12% nationwide. Available stock is still massively down. We're looking at in sales 8% down nationwide, 20% down year on year in London. For lettings, a whopping 58% down in central London, or in London, I should say, 40% down nationwide, which means that properties are literally flying off the shelves. I'm sure Marc as an agent will say they actually often, the properties don't even make it to Rightmove and the other portals because they go so quickly. But you know, we are down at an average property sale for a sales property, I should say. Is now less than a month on site. This is a massive reduction in terms of time. We're looking at a 40% reduction, less than 3 weeks on site for a lettings property at the moment. So maybe we might at some point in the next 12 months, people will start quietening down, but there is no evidence to support what all the various pundits are actually saying. The cold hard evidence, and yeah, those are stats that were accurate on our site as of midnight last night. I've literally.
So you're saying no, David?
I'm saying no. There's no evidence to suggest.
Good. Yeah, I agree. To be fair, you're right. We are incredibly busy as a business, and I'm going to let Vanessa do this. Vanessa, you go next, because you did tell me about a pretty interesting story you just had. So, is there going to be a property? Are we heading for a property market crash? Vanessa, you're on mute. You're on mute.
Sorry, there we go. Well, you know, crash is a very emotive word. Yes, I agree. There's been MSM doom mongering of late, but you know, a crash, we're talking maybe a 30%, you know, decrease. And you know, as we know, Marc, when you and I talk on our collab webinar, there's no such thing as the average property in the UK. We are dealing with thousands of micro markets, even down to a street level. So you just can't talk in such general terms. I do think we are facing headwinds. It's a very, very inflationary environment. We do have concerns, you know, about the Bank of England base rate. We do have concerns about tenant affordability being stretched by the energy crisis and the cost of living crisis. So all of these things do come into play, but I can't see there being a crash. I can see that maybe there might be a slight softening or a slight correction. And in a way, to my mind, that's healthy, because the activity and energy in the market we've seen in the last, I don't know, year or so, I don't really think it can be sustainable. It's got to find its own level again. So I think as we go into autumn, winter, we may see a slight softening, and there may be a slight correction in some areas, but not all areas. And I think it's good quality stock in you know, areas with good amenities, good transport links, where families want to put down roots. I think they will be fairly robust going forward, whatever happens.
Good, good. Okay. Chris, do you want to take the view from a tax perspective? Is there going to be a crash? So there's going to be less money hitting the coffers of the revenue, or is it going to, or do you forecast it's going to continue?
No, I think I actually agree with Vanessa, and I think not that I'm disagreeing with David, by the way. So I do think that there will be a correction, and I think that's the correct word, a correction. But I think that, as Vanessa said, good quality property in good areas will always go well. It'll always go well. And the thing that we're hearing most about at the moment, and I don't know if Vanessa would agree, would be the changes in relation to the EPCs that are coming in. Because that's a massive thing. That's a massive thing. And people are selling their older properties to buy newer ones, so they don't have to do all the upgrades and everything on the EPCs. And that may well be driving some of what's happening.
It's interesting. Thanks, Chris. Conor, view from the mortgage market, crash coming, everybody piling in or rushing away?
From a mortgage perspective, you can't really see the crash coming, Marc. Mortgage rates are still low. I know the base rate's going up, but it's going up from a ridiculously low starting point. So mortgage rates are still very affordable. The mortgage market's still buoyant. Last year was the largest gross lending market since 2007 in terms of the gross new lend that the lenders did in aggregate. So they lent 320 billion, which is the highest since 2007. The lenders' expectation for this year is that the market will be as large as it was last year, if not slightly larger. If you speak to the individual lenders, they're all looking to match what they did last year or possibly increase it. So if you look at it from that perspective and the availability of mortgage finance and the cost of mortgage finance, there's no major problems on that side of the market whatsoever. And then just taking another mortgage perspective that almost underpins the same point. Even as mortgage rates are increasing, it's still cheaper currently to buy a property with a mortgage than it is to rent the same property. And then if you look at the affordability stress tests that lenders have been applying for a number of years now, they're set at such a high level relative to what people are actually paying on their mortgage that there's such a large degree of headroom there for most people, that the mortgage that people have is very readily affordable today, and even in the future, even if base rate does increase a few more times from where it is today. So all of those things together.
That's interesting, Conor. So let's ask you that, because actually someone's just asked that. How high interest are going to go? Where are they going to go? What impact is it going to have on mortgage affordability? So you just talked about that. So actually where do you think rates are going to go?
I would personally be very surprised if in the next 2, 3, 4 years, they go beyond 2.5% to 3% in terms of base rate. And then with a margin on top for the lenders, you're looking at potentially getting to a point where they're low to mid threes, which still by historic standards is relatively low. It's still very affordable, and it's still well under where the stress tests have been set for a decade. So you look at all those things and you say people could afford the stress test, or else they couldn't get the finance to start with. If they could afford the stress test and the actual pay rate is still lower than the stress test, then they can afford the pay rate.
Okay, good. Actually, let's ask everybody else. David, where are interest rates going?
I have to say, I probably agree with Conor on that one. We are in a period of historically low interest rates, and I think particularly for the new generation of buyers who have only ever experienced this, to increase it massively, or to even consider going back to the rates that we saw in the 90s, then it will create a massive economic upheaval, because there is an entire generation of people now who, whether they are the generation that were the buy-to-letters in the noughties and the teens, or they were the people that were children in the 90s and noughties who are now buying properties, they just are not accustomed to interest rates in double digits, and therefore to even suggest going back to that in any time soon, if that is something that we need to, it's going to take at least a decade, I would suggest. So I agree with Conor.
Good. Vanessa, do you think they're going to go up much?
I think they will creep up a little bit. I think the Bank of England is in an almost impossible situation trying to deal with the inflationary environment. They're running out of tools to deal with it, truth be told. So that is one of the tools in their toolbox to manage the inflation in the UK. But, you know, we've got so many outside influences now, like, you know, the Russian-Ukraine war, which, you know, none of us have got any control over. So it's a very, very challenging time. But I do think what Conor said is important, because access to finance is absolutely vital to keep the property market healthy. And it's really good to hear that there's still lots of good value mortgage products around. And I see new products coming out on a regular basis, new lenders joining into the buy-to-let scene. So I think that is a good indicator of the general health of things going forwards. And, you know, there is, as Conor said, there's still some highly competitive rates around. So I can see the base rate creeping up a little bit. I think, you know, there's going to be a lot of competition in the mortgage market, which will, you know, keep it healthy and keep it good for landlords, lots of choice out there. So it's just such uncharted waters that we're in now. It's really hard to call it, to be honest.
It's interesting. Chris, no, thanks for that. Chris, what do you think? Do you think there's going to be, you know, interest rates are going to go up, edge up, or jump up, or stay even?
Well, I think that they will go up. I think that's obvious. I think they have to go up. I can't see them staying where they are. But of course, remember that in the buy-to-let market, we're not allowed anymore to deduct our mortgage interest from the profits. So as they go up, you're spending more of the profit on an item that you can't deduct for tax purposes anymore. So it may affect that market slightly more than the normal residential market.
Yeah.
But it's I think they have to go up. I just can't see them not going up. That's the thing. It's where the government think that they need to be at. I think, and if that's another 1%, another 2%, I think we're just throwing balls in the air, aren't we?
Yeah, I think I agree with you. I think they're going to go up, and I think there's no reason they can't. And as Conor said, I think there's an awful lot of headroom in the market because the margins that the banks take is quite high, and that will only get crushed over time. So I don't see it really hitting the pockets too much as long as they only put on another you know, 1.5%. So interesting. On the back of that, a couple of people have asked about stamp duty. So Chris, you may as well take this. Do not what stamp duty is, because I hope everybody knows that they have to pay stamp duty. It's whether or not there's going to be, whether we think that the Chancellor is going to do something nice to help people on stamp duty, you know, because a lot of people are put off by the high stamp duty levels. Is there anything going to be done?
In a word, no.
Oh.
And the answer and behind that answer is, you know, what we need to believe is the country's got no money, has it? It's got no money. And while stamp duty is very, very painful for people, which it is, obviously it is, you know, it's collecting taxes at the moment. And it's, you know, its worth to the Chancellor is growing every day, isn't it? As the market expands, people are having to pay it. And I can't see, you know, I can't see him reducing stamp duty, because what would the result of that, as me as a simple soul, would be the housing market is going to go even faster, presumably.
Yeah,
I agree, Chris. In a buoyant housing market, why would you reduce it? Yeah. If the market was flat or they needed to inject some momentum into the market, they'd do that. In a market that's shooting up anyway, even if they thought it was the right thing to do long term, they wouldn't do it right now, I don't think.
No, they're rubbing their hands, aren't they? At the moment, they're just rubbing their hands with it.
We're certainly seeing that. I think people were deterred from it, especially some overseas buyers with the additional stamp they have to pay. But we certainly don't see any change. It's interesting. One question, Conor, because you just touched on, you obviously were talking about interest rates. Someone's just asked, are a lot of valuers, they hear that valuers are down valuing like mad at the moment, and is that becoming a big thing again because they're becoming twitchy about this crash that we've all advocated is not going to happen? But our mortgage, are the banks telling them the valuers?
We're not seeing it as a major problem, Mark. So it's something that pops up every now and then. You often see it, certain areas, certain developments. To Vanessa's point about the property market is actually thousands of small micro markets. You'll often see that in little pockets of London, or pockets of pockets, almost small areas, small developments. You might see certain schemes or areas that they have particular concerns about, but we're not seeing a systemic problem where they are down valuing across the market. We're certainly not seeing that.
Good, that's good to hear. That's really good to hear. So here's a nice, easy question to answer. So if you were a first-time buyer, or for that matter, a buy-to-let landlord, would you buy a property right now? If so, why? And if not, why not? Vanessa, come on, you'll be able to answer that.
Well, the only time that any of us have to buy property is now. We can't go back in the past, and unless we've got a TARDIS, we can't go into the future and buy property. So the only time that any of us can take any action to improve our financial situation is today. And there's a very famous saying, which I can't claim for my own, but I do subscribe to, and that is, it's not timing the market, it's time in the market. So to benefit from property investment, you actually have to own some. The longer you own it, generally speaking, if you've bought correctly, then you're going to enjoy the benefits of it. And property is a very, very long-term investment now. I mean, we used to say 15 to 20 years. I think it's more like 20, 25 years now. And, you've got 25 years ahead of you. So the sooner you get started, the sooner you're going to start reaping the benefits. And one of the things that we can absolutely 100% guarantee in property investments is that time is going to pass. I started out full-time in property in 2004, and I can tell you now that time has gone like that.
Good. Do you want to take that, Conor?
I would agree with everything Vanessa said. I mean, I started out as an investment advisor. So I was a private banker and investment advisor, and then specialized in mortgages. And all the points that Vanessa raised about investment and, it's time in market, it's not market timing. That's entirely true. And if you place property on the curve of different investment classes, property is a long-term investment. And people that think it isn't and think that you might occasionally get lucky and there might be short-term flipping opportunities in certain markets at certain points in time. In general, it's a long-term investment. You buy the right property in the right area, you hold it for a long period of time, and you will do very well.
Agree. Totally. I mean, I'll come to the others next. I mean, I've got to totally agree that my view is it's a long-term investment. Years ago, people would be able to buy off plan and then wait until completion and flip it. That is incredibly difficult. It affects your ability to get finance. And frankly, you know, it's finance that actually turbocharges a property investment by having debt on it. Yes, Chris was right. The interest is not fully offsettable anymore. But it's still what else do you invest in where it's so easy to get finance on it and help your investment? And I think, you know, Vanessa, 25 years is a very long time, but I mean, I still say it's a 10-year hold. And I think it's a 10-year hold, you'll do well. You know, 5 years, the last 5 years have been difficult for London landlords and London owners. Outside London has obviously done very well, but for London, it's been, but over a 10-year period, the returns have been very good. So my view still is that this is a long-term hold. And so the question was, when is it a good time to buy? Now, or and if so, why? And my advice on that is similar to what Vanessa said, time in the market, but actually the best time to buy is when you're ready. Do you have the cash ready to do it? If you don't have the cash, don't waste your time trying to borrow from credit cards to do it. Just wait until you have enough money to get a decent deposit, and then Conor can get you 100% mortgage. No, I'm joking. He can. We'd love to think that. So Chris, what's your view? If you're a first-time buyer or a buy-to-let landlord, is now time to do it?
I would say so. I would say it is. You know, you might be hopping on the back of a raging stallion that's about to go bouncing around the place. But I think what we can take from certainly Vanessa's and Conor's and yours, Marc, your comments then, is it's a long-term thing. You know, you're not buying a car or anything like that. It's a house. You know, it's a large investment. You know, and you've got to be set up right to do it. As you say, you've got to have all the finance in place. You've got to have the structure in place. Everything's got to be right, and then go looking and buying. Because if you rush into it, you know, you will probably fail, because you'll not, you know, do research, proper research around areas, all that sort of thing. You know, look at stats. I'm sure David's got 101 graphs in front of him of areas that are going up and down all the time. And you know, if you look at a graph today, it'll be different tomorrow. But look at it over a long-term period, like you would any investment. And you know, as Vanessa said, you know, it's time in the market. That's really important.
Yeah, I agree. I totally agree with all of that. I mean, the other fact that I often tell people is that you look at who the wealthiest people in the UK are. You know, in top 100, how many of them are landowners? The Grosvenor estate, the Cadogan estate, the Queen, the Crown, as it were, which is not the Queen anymore. But if you look at that, and they've owned property for a long time, they're not in and out. They are long-term holds, and your wealth grows on that basis. David, if you're a buy-to-let, first-time buyer or buy-to-let investor, is now the time to do it?
I think there's going to be an outpouring of agreement on this particular one. I agree with everything that has already been said. I suppose the only point I would add is the housing market works in waves. So, you know, as you've just said, Marc, the outside of London has been doing very well the last few years, particularly after the pandemic, as people moved away from London during the pandemic for more space, outside lifestyles, and to get away from the small living of the city. But that's just not, as Vanessa pointed out, it's not one market. And when London is doing well, it's to somewhat depress the outside of London. But you know that when prime central London goes up, that wave will ripple out over the ripple out over the next 3 or 4 years over the country. So at the moment, you know, even within London, you can see the wave. Prime outer London is doing really, really well at the moment. Prime central London, prime inner London is still not back to its pre-pandemic level. I don't think you need to worry about that. They will come back and they will continue going up. But at the moment, the wave is going the opposite direction, and outside is higher than inside. We've just got to wait for the wave to return.
Isn't it a good time, therefore, to do opposite what the wave's doing? See, I think anybody that looking to buy at the moment is good to buy in prime central London, because actually prices have been flat and come off a little bit over the last 5 years. And actually you're doing that, you're going to see people, that's that's often a good thing to do, is to go against the curve.
Well,
I
that's what I
completely agree.
did. Yeah, sorry, I was just going to say that's what I did when I got started in 2004. Marc, it was London had been flat for years, and I could see that there was headroom for growth. But I just wanted to jump in and mention that we talked about mortgage rates as well. Lock in a good rate now, because if you wait and wait and wait and sit on the fence, if we do have interest rate rises, rates are going to go, mortgage rates are going to go up. And over 25 years of the typical length of a mortgage, that can make a huge difference. So, take action with what you know in the current circumstances. You can't kind of predict what's going to happen in the future. So you can only act on what you know in the now.
Great. This is quite an interesting question. So it's on the back of what we just discussed. So, with the massive amount of developments going on in London at the moment, with no sign of slowing down, is there a case of oversupply, which will lead to down valuation of assets in the coming years? I mean, who wants to, do you want to take that, David? Because, from a stats perspective, there has been quite a lot coming on.
There has been a lot coming on the market, but at the same point, demand is up massively. And there is a clear shortage of properties on both the sales and the rental market at the moment, which is pushing prices up. People have talked about, yes, there is an oversupply, and going back to Vanessa's point, that the housing market isn't one homogenous market; it's thousands of micro markets. I have to say, I'm afraid I do have to slightly split. I can separate my stats easily from London and outside. It would take more time to do it in more granular detail. But as a general rule of thumb, the government is estimating that we need to build 300,000 homes every year in order to merely meet demand. We've got housing waiting lists running into the millions. We've got every local authority creating local housing plans that say that they need 3,000, 5,000, 10,000 homes in their local borough being built every year just to meet the ever increasing demand. What we have seen as well over the last, it was starting just before the pandemic, but we've seen a massive ratcheting up during and since the pandemic of smaller households as a result of family breakdowns, more people choosing to live in smaller single units, 2-bedroom units. And that is a very much reversal of what we saw during the teens, when there was a massive need for 3-bedroom, 4-bedroom family houses and a big glut of 2-bedroom flats. That has now flipped. And whilst there are parts of central London, I'm particularly thinking Nine Elms, where there is a massive glut of 2-bedroom flats at the moment. But generally, most of the places, it is smaller units that is where the demand is happening. And we can certainly see that from our stats.
It's interesting from an agency front end perspective. So if people don't know benham&reeves, then we have 19 branches throughout the capital. We're opening our 20th at the beginning of next year. And actually, we're seeing demand for smaller units, which we always have done. But actually, we've seen demand rise across all size areas. We are, like David's saying, the demand is ridiculous for properties in almost all areas. And that's from large houses all the way down to small flats. And it's really interesting why we're seeing this. But I just think we all struggle with the lack of stock. So it's quite interesting. So actually, I don't see an oversupply. I see we continue to have an undersupply. And I think that, Nine Elms is a prime example. Yeah, there is a lot being built, but equally, a lot of it's been rented. So Vanessa, do you see a lot of oversupply because you're a London landlord? Do you see that being a problem?
I don't really. I don't. There has been some commentary in the media that there's been quite a significant decrease in planning applications for very tall towers in London. And there's also commentary about developers struggling, with inflationary pressures and, prices going up and so on and so forth. And I think this will start to constrict the pipeline over time, which, could keep it quite well balanced, I would say. I think it's interesting that yourself and David have mentioned about the high demand for smaller units. I suspect that the pied-à-terre is coming back into favour with this kind of hybrid model that people seem to be kind of sticking to now, certainly becoming embedded. There's going to be people that want a 1 or 2 bed flat for when they're in town, and then they may have other accommodation outside of London. So I can see that 1 or 2 bed apartments will continue to be in high demand. And of course, as we've discussed in the past, Mark, they're always the entry level into the market, so they're always the least expensive to rent and the least expensive to buy. I'm a great believer in London property. My main reason, as I've stated before, is that London has one thing that can never be taken away from it, and that is Greenwich Mean Time. So it's always going to be a financial hub, and I think in times of trouble or economic uncertainty, it does become a safe haven. And attracts foreign investors, which you're seeing as well, aren't you, Mark? So
yeah, we definitely are.
Yeah, I think it's good times ahead for the London market.
Conor, do you think?
I would agree. I think London's one of the few truly global cities.
Yeah,
and I think the demand for London will always be there. So I don't think there's necessarily an oversupply. And the reality is, I think they could probably build a lot more new homes in London and fill all of them. The bigger challenge, I would say, actually is probably on the infrastructure side, that as you build more houses and you have more people, you also need more schools, hospitals, public transport. We've all been suffering this week with another tube strike, and that has a major impact then across the whole city, movement and so on and so forth. So I think there's other challenges that sit around that central challenge. But in terms of oversupply, I don't really see it myself. And I think the demand is there, and that will cover it, yeah.
Just quickly, I'm going to come to Chris to give his view, but what period of mortgage would you recommend? 2, 3 or 5 year fixed rate interest only mortgage?
I would match it to individual circumstances, Mark. It's so hard to say that as a general point.
If you're a buy-to-let investor.
If you're looking at the pricing right now and you're a long-term investor, which is what we all advocate, is that people should be long-term investors. If they intend to buy and hold for 10 years plus, there are some 5-year products at the minute that are priced almost identically to the 2-year products. If you intend to buy and hold anyway, then in that situation, I would go with a 5-year fixed. Lock in your money and know what you're paying for the next 5 years. But different people have different situations.
Sure. Chris, oversupply, is it going to kill the market, or is it going to get snapped up?
Excuse me. I think the rest of the panel have answered it for me. I think I think we all think that it isn't an issue. I think it seems to me, coming from the north, coming into London all the time, that there's building everywhere. They're building everywhere, and they must have plans. They must have ideas of what's going to sell and what's going to rent and everything else. So the builders and the developers, I think they've all been shocked by the inflationary pressures. I think that's a point for definite. And it might slow down slightly, but if it slowed down slightly, that then means that the supply is slowing down. Yeah. So it means the market's going to get hotter potentially.
Well, that's the point. With one of the things we work with most of the UK's largest house builders, and as a business, what we're finding is they're saying, our cost of materials has gone up, and that's made some projects less viable. When they say less viable, less profits, obviously. And if they mothball the project, which is lower on the thing, they don't build it, so there's less supply. And I think that only fuels the market. Okay, Chris, so here's one for you, which is a question someone asked. What's the best structure to keep more money in my pocket? He's a landlord, or she's a landlord, in my pocket as a non-resident landlord. Sorry, it's a landlord. How can an individual owner reduce their tax bill? Should they buy in a company or give it to their kids?
Oh dear, I think I'll just quote Conor on that one. That's a very generalistic question and a very general answer. Clearly, I can't give absolute advice, with a one-liner, and there's lots of different ways you can do it. What you need to be careful about being a foreign landlord is exactly that. Being a foreign landlord in the UK, you get taxed more than you would having a UK structure. So you need to have a UK limited company or a UK LLP or something that is a structure that is a UK based entity that you can then invest into, that then can buy the properties or buy and then rent the properties out, obviously, if that's what we're looking to do. But again, you've got to be careful because there are tax loopholes, or not loopholes, tax steps you can fall down, if you like, if you're not very careful. So things like the ATED, the enveloped dwellings tax that's come in, you've got to be really careful about buying homes in expensive homes in companies, because that can be an expensive tax loss as opposed to a tax gain. You know, you've got to decide what you want to do with the property as you know, are you buying it to develop it? Are you buying it just to rent it, to hold it? A lot of people these days are looking for properties with big gardens, so they can split the title and the gardens and build properties in the garden. A lot of people are looking at buying bigger houses to split them into various flats. There's lots of things that you can do and that are going on that will make you more profit. But what we say at Less Tax is, don't let me make sure I get this phrase right, because I always get it the wrong way around. Don't let the tax tail wag the business dog.
Yeah.
So don't just look for the tax savings. If you're making a profit, that's
a good thing. That's
great. Absolutely great. And you know, everyone has to pay tax at some point, but it's the level of tax that's what people complain about. You know, are you paying the right amount of tax? Get the structure set up correctly to start with. You know, there's lots of things to think about even before you start looking for the property. So like you said, Mark, are you going to buy in a limited company? Are you going to buy in an LLP? Are you going to go in a joint venture with someone? Are you just going to invest with someone? Are you going to lend someone the money so they can go and buy the property? You know, there's lots and lots of different things to think about. What's your own personal circumstances? You know, do you need the money back in 5 years, in 10 years? Do you need regular income coming off it? Are you happy just to invest and leave it? There's lots and lots of different things to think about.
Are you seeing, someone's just asked, are you seeing lots of landlords who own it in their personal names transferring into companies? Are you seeing that now?
That has been a steady stream over the past 5 years. Absolutely. And
is that better for you, more for UK people or overseas people? Because obviously if I'm an overseas person and there's no tax on outside of my country, I don't pay a dividend tax, which UK people find. So
yeah. I mean, it all depends. I mean, there are mortgage restrictions if you're a foreign person, so you've got to be careful buying in your own name if you're a foreign person. You're buying through a limited company and you've invested into the shares in that company, then the cash is in the company. So it's a UK company. You know, I'm not taking Conor's thunder, but that's, you know, but it's easier to get a mortgage in a company. But then 5 years ago, the mortgage companies didn't like lending into companies. And because of the massive market shift into that way of doing things, it meant now that market has opened up. I'm not sure whether they're still as expensive. There were certainly 1 or 2 points above where residential personal mortgages were, but it's for companies, it's, you know, it's can be safer to invest through a company.
Okay, thank you for that. So this is an interesting topic, which obviously just happened from the 24th of May, is Crossrail. So, you know, is it a real game changer? And is it now best for central London or for outside London? I think that's about, you know, where it's going to give the most benefit. David, do you want to take that first?
So I have to say, in terms of the stats, it's too early to tell. It's really only been up and functioning for a little over a week at this point in time. So there are no stats as to what impact it is having. Anecdotally, I'm somebody who works in central London, just off Soho Square, which is about a 30-second walk from one of the new Elizabeth Line tube stations. My colleagues who are out of the city centre are loving the fact that they can get absolutely into the heart of London in a matter of minutes. Journeys that used to take 3/4 of an hour are taking them 10 to 15 minutes. So that is nothing more than anecdotal feedback from, you know, the 250, 300 Rightmove staff that actually work in central London on a daily basis. But if that becomes a sort of nationwide, or at least a London-wide trend, that if you can get right into the heart of the city in only a few minutes, that is going to start making the areas around the Elizabeth Line station that are further out, where you can get more space, your garden, and you can have the sort of almost the out of London lifestyle in London at an affordable price. That's going to start increasing those property values. So I would suggest it probably is a good time to look at property around the Elizabeth Line stations, but that is nothing more than gut reaction and anecdotal feedback at this point in time. It is not based on any sort of empirical data.
I think it's interesting. Thanks. No, I must admit, I mean, we've been talking about Crossrail for years and years and years. And when it was announced, there were lots and lots of buyers in Asia, because people in Asia, they get infrastructure and they get how we do it. I'm not being rude about British people, but we didn't really get it. In fact, my kids still don't even really understand what it means. But I think that they got it and they jumped on it, and there was an awful lot of hype and prices moved up. And then it was like delays. When's it going to come? When's it going to come? Is it ever going to come? And I think that meant people were so bored, they didn't price it in anymore. And developers were just selling at normal prices again. I think now it's opened. I actually think you're going to see price increases around the stations for the very reason David said, being able to get in. I mean, it's amazing, from Reading into Paddington in like 15 minutes. It's mad. Conor, how are you finding about price, with buyers, with mortgages?
I think it's too early to say, as David said. I think it's too early to say that there's been any noticeable change from our perspective, but I would agree with what you've both said there in terms of the lifestyle that offers. And I would say that between the Elizabeth Line being announced and obviously it going live recently, you've had the COVID pandemic in the middle. And so you've had this huge shift to hybrid working anyway. And if anything, the benefits that the Elizabeth Line offers, and the fact that you can travel to central London in 15-20 minutes, that amplifies that movement towards hybrid living. Because you could then quite easily, taking David's office in Soho Square as an example, you could live outside London, you could have the perfect outside London lifestyle 2 or 3 days a week, and the days that you need to come in, it's a short hop into London, do what you need to do, and then go back again. So in a way, those two things I think go hand in hand.
So that's interesting. If you're saying that, actually, and you both said that, if that's the case, does that mean that that's going to impact central London prices, prime central London, because no one will want to live in the centre because they can live in Slough or Reading or, right on the outskirts? Does that mean prime central London is going to get hit? Conor?
I mean, it possibly could. What I think all of this lends itself to actually is I think it's a lifestyle shift generally. So I think people are less forgiving of having an hour and a half commute every day to and from the office, which people just got used to and did for years and years to come. There's two ways you can get around that. You can live close to work, or you can have a really easy commute to work in the way that we've just discussed there. So I think there's pros and cons to both. I think as attractive as it would be to live in Slough and commute to Soho Square in 15 minutes, it would always be equally attractive to live in and around Soho Square for certain people and to have that lifestyle. So I think they both have, there's pros and cons on both sides.
I would agree, and I'd actually say it's about a lifestyle choice, and if I may, it may even be somewhat of an age choice, that as people are younger, going to university, young professionals, they want to be in the hubbub of the city, they want to be right in the heart of things, they want to be able to walk to work, because as you get a little bit older, you start having children, you want the space, you don't mind the commute, you are less likely to be rolling out of a nightclub at 2 o'clock in the morning and having to think about the extortionate expense of a taxi back to Slough. You would much rather be able to walk home. So it swings and roundabouts, and it is the ideal solution for the position that you are at that time of your life.
Yeah, I agree. Vanessa, what do you think on that? Do you think Crossrail is making an effect? I mean, to be fair, let me make one point. The one thing that it has shown, it's already, in fact, someone just mentioned this, I was going to say at the end, but Elizabeth Line already shown its value. It remained open fully during the tube strike. That's interesting.
No, it is. I think those investors that got in, 3, 4, 5 years ago will have done extremely well. there will have been significant capital growth around it, and that's really coming into the frame now with all this commentary around how amazing the Elizabeth line is and reducing the journey time, etc. So I think it will impact prices and indeed rents, but from an investor perspective, I would probably think you've missed the train, to excuse the pun. You know, these, once things are called hotspots in the media, it's too late. What you can do is take a lesson from this and see, you know, where else is infrastructure going in London, and where you can buy at good prices before the masses come in. But yeah, I'm sure, you know, as the other panelists have said, we are seeing that people are willing. I think the commute has probably got a bit longer. I always thought it was about an hour, but I think if you're only going in 2 or 3 times a week, maybe you'll consider a slightly longer commute. You might think about moving slightly further out. So we are hearing, you know, that outside of the M25 now, there's some good activity in certain areas, and it's very much, I think, those that suffered from FOMO during the pandemic, fear of missing out, they're going to stay loyal to city life, and then there's those that like to have the best of both worlds with maybe a pied-à-terre and live outside of London, and then there's those that, you know, very happy working from home and continuing to work from home. So early days, but it's a very positive thing for London in general, I would say, that these commuter times have been reduced. And as you said, Marc, it stayed open. So that's a big thumbs up to the Elizabeth line.
Yeah, it's interesting. I mean, there was that obviously move out of London, more space, cheaper. I'm going to be working from home forever. But, you know, there's been some big employers. Tesla's just done the announcement with working from home ending and need to be in the office. What did he say? At least 40 hours a week we need you in the office. I mean, that's fantastic. But you know, it is interesting, and we're seeing people who bought outside London coming in now renting to have a pied-à-terre because the travel costs are still expensive. But what about, let's let Chris do this, because as he mentioned, he's from the north. What about the northern powerhouse? Is this now just a catchphrase, or is it really a thing, or is it just a catchphrase where really you should just look at London?
Well, it depends what you're looking for, doesn't it? If you want a lovely outside life with nice restaurants and nice country pubs, nice pint of beer, nice food, nice people, not that people in the south aren't nice, but then the north is for you, isn't it? And we've seen, you know, we've seen prices in places like Liverpool, in Manchester, in Newcastle, in Birmingham, going through the roof, absolutely through the roof, because people in London were, as I understand it, were selling their properties in London and then looking for the cheaper alternatives up in the north, where, as I said before, it all depends what are you looking for? Are you looking for yield? Are you looking for capital growth? My portfolio in the northeast of England, we average 10 or 11% a year, which is great.
Is that on original purchase or on current value?
On original purchase. On current value, it's about 8.
It's still pretty strong. So someone just asked the question, you may as well finish this, is do we think that the boom in 1 and 2 bedroom apartments in major cities like Manchester, Liverpool, Birmingham, Nottingham is over because there's so much oversupply, and they should look for other areas and maybe even refocus on London?
That's a really good question. That's a really good question. And I don't think it is over, not from what I'm seeing. I mean, our properties are 2 bedrooms, 3 bedrooms, and the 2s certainly go quicker than the 3s, certainly. And, you know, in the north, that's what we hear from a lot of the landlords. I think you've got to look at what the market wants, obviously, you know, do research, as I said before, but I certainly think that the boom in the north isn't over. I think the boom will continue. I think what you do see in the north is that the north is slightly behind London, and it's always a bit lower than London. So whilst London flies, or the southeast flies, the north comes slowly behind it. It doesn't dip as much, but it keeps going up. And I think that's where we are with it in the north.
Yeah, okay, interesting. And someone just mentioned that the civil service are moving more functions out of London to Darlington. So
Yeah,
interesting.
May I jump in there, Mark?
Yeah, go on, Vanessa.
Putting the landlord lens on this, a £40,000 house up north that's an F or G rating for EPC is going to cost the same to get upgraded as a £400,000 house in the southeast. So if you've got a £400,000 house earning you, let's say, £2,000 a month rent, and you've got a £40,000 house up north earning you £350 a month rent, and you've got to spend 10,000 on, or even 13,000, I think is the average amount to upgrade a property to a C or above rating. Just think of the maths. It's going to take ages for that £40,000 house to come good, whereas the £400,000 house will pay that back in a much shorter time frame. So do be careful of talk of going up north and cheap properties, etc. You must crunch the numbers, because the numbers will never lie. As long as you put the right inputs in, you'll get the right outputs that will help you make a wise decision.
And to Vanessa's point there, Mark, I'd say that from a mortgage perspective, there is a huge push in the industry. Every industry conference we go to at the minute, every time you have a lender forum, all of the talk now is about green mortgages and the movement towards what Vanessa's just described.
Yeah.
Lenders do offer green mortgages today. The differential, to be honest, there is no difference. There is no real benefit.
Green mortgage? Why don't you tell us?
It's where products have certain, so you've got EPC ratings that go, I think it's A to F. Vanessa probably knows the classifications, but where they've got the higher rated properties and they meet the required threshold, they benefit from different mortgage products. But at the minute,
cheaper mortgage rates?
In theory, cheaper. At the minute, it's not. It might be a slightly adjusted arrangement fee, so there might be some financial saving, but it's minimal, to be honest.
It is a looming problem, don't you think, Conor? Because I'm just doing a remortgage, and the lender is looking at all of my EPCs across my entire portfolio, because they want to know that I'm going to be able to deal with these upgrades when the time comes. And we don't know when the time is, because at the moment it's 2025, but it's not actually been written into government statute. So we're all basing decisions on things that may or may not come to pass. It's very, very hard to make good informed decisions at the moment, but I do know that, and I'm sure Conor will confirm this, that lenders are looking increasingly at energy efficiency across entire portfolios. And I found that one of my properties is a D, and they've said I have to get it upgraded to C before I can do the remortgage. So this is a big problem that's really coming down the pipe very fast, in my opinion.
And I think where you'll end up, Vanessa, is you'll end up with differential, i.e. better pricing on the A's to C's, so the ones that are attractive. You'll end up with standard pricing on the next couple of categories, and you might find therefore that there's some properties that have very poor energy efficiency that end up becoming unmortgageable. And the way that will end up happening is that will almost be imposed upon the lenders. So the lenders will have to balance their books to manage that energy efficiency, and all that then happens is they flow it down to the end customers, which they're already starting to do. So their concern is if they take Vanessa's portfolio on today, for example, and that has a mixture of different energy efficiencies across the portfolio, at some point they will have to balance that out on their side.
That's interesting.
And over the next 5-10 years, you'll see that really pick up pace.
I think that's a really important point, because we've really only thought about energy efficiency in the lettings market since we've had the minimum energy efficiency standards for the last four plus years. However, whilst no government is going to attack homeowners and start imposing minimum energy efficiency standards on homeowners, the way they are going to do that, and the way they have announced that they're going to tackle the owner occupation, is by going after the mortgage companies, on whether they are going to slap a levy or something for lending to low energy efficiency, or increase tax in some way. We're waiting to hear from it, because as Vanessa's just said, we've already had the announcement pretty much of EPC band C for lettings from 2025. No government of any persuasion is going to do that on owner occupation. It's a ticket to being booted out of Downing Street. So they're doing it by the back door and coming after the lenders instead. So what I would say for those watching and thinking about their next investment, look at the EPC band C in the lettings, whether you are planning on letting it or not. Think of an EPC band C and really question whether, especially if you're buying with a mortgage, whether it is something you want to do. And this is going to apply sooner or later in the owner occupation sector, whether it is a direct attack like minimum energy efficiency standards have been, or through stealth taxes via the mortgage lenders. It's something that whatever your choice is in property, it's going to hit you in the next decade or so.
I agree. I think that where congestion charging came in London, and the tax on diesel cars, everybody buy clean diesel cars, and all of a sudden, you're parking in Westminster and it's £8 an hour because you've got a diesel car. It's mad. And I think you're going to see the same on EPCs. They've already started on lettings because, let's be honest, landlords are an easy target. Owner occupiers are only the next ones down, and the only way that they can stop owner occupiers or force owner occupiers into doing it is through the banks. And they can try and do it through the council tax, but that will be politically really unpopular with councils, so they won't want to do that. Where it's really easy to say to the banks, you need to add 2% interest onto anybody with an E or F or G, or don't lend to a G. It will, that's that, and the poor banks are the ones that are going to take it in the neck. But we're almost at the end, so I think the final question, and I think this is a fair final question, is what's the prediction for house prices into 2023? I just want very, very quick, and your estimate on where it's going to be middle of this time next year. How much are we going to see increase? Vanessa, go on.
Well, I just want to quickly say about my anecdotal experience, hot off the press. I put a 1-bed flat in N5 on Rightmove, and within 48 hours, I had 107 applicants. And then I had 17 viewings yesterday, and I've got 4 offers at above the rental market price, which I'd already raised £100 from the outgoing tenant. So I want to end on a very happy note that demand in London is absolutely off the scale. I have never had 107 applications before in all my 20 odd years of investing in the capital. House prices, well, we're down to a street level again, aren't we? But I'm going to say that generally across the board, maybe 2 or 3% over the next couple of years, which I think is healthy.
And rentals?
I think they're going to do well. They're on an upward trajectory. There's a massive shortage of stock, as we're hearing in the media. Grave concerns about blockages forming in the private rented sector because tenants can't find anywhere to move to. So they're staying put even when the landlord is wanting to remove them. We've got local authorities offering these golden hellos, £2,500 incentive to give your property over. I mean, it really is in a crisis situation now. So
what do you predict?
Rents are going to go up.
How much?
Oh, I don't know. I wouldn't like to say. It depends, but certainly in the southeast, I think they're going to continue to do very well. And
okay, fine. Chris, what do you think on house prices? Where do you think the increase is going to be over the next year?
I'm going to be slightly more upfront and increasing than Vanessa. I think not 2 or 3. I think 4 or 5%.
Yeah.
I think, and I think rents will go up as well. I think landlords will take the opportunity of spending the EPC money that they have to do and increase the rents because of it.
You think you're going to go up 5% rents?
I think so, yeah.
It's good, yeah. Interesting.
Conor? Make more money, Marc, anyway.
No, sure. But it's interesting because I think we all keep saying this about the difference between different areas. I actually think you're going to see average, my view, I'll just do my quick one, is I think we're going to see average house prices increase by 5% in the UK. I think you will see less in the north, and I think you will see more in London. Why? Because London has been out as travel resumes and people start to come in and people stop working from home and the Elizabeth line continues. I think you will see London prime prime, super prime, prime, and the general suburbs, zone 1 to 5, I think you'll see the biggest growth there on sales prices. On rents, I think we're going to see 7 to 8% growth. I'm more bullish because the demand is off the hook. Conor, what do you think? House prices?
Similar to the rest, Mark. I'd say 3 to 4% increases in prices and probably 5 or 6% on rentals. But I'm pretty optimistic across the board.
Good. Come on, David. Let's have a doom and gloom one from.
I'm afraid you're not going to get a doom and gloom one from me. I was going to say exactly the same as you did on house prices, Mark. So I reckon we're probably talking on average around a 5% increase in the next 12 months. I'm actually going to go even further on rents because demand is so high. If you look at all the national polls and the trade body poll, they're saying that the number of landlords are leaving the market. And when you have got massively burgeoning demands, increased costs, as Chris has just said, in terms of the EPCs meeting a reduction in supply, I wouldn't be surprised if we had double-digit growth in rents again next year.
Wow, that's indeed good news for landlords. So getting back to the first or second, third question, is this a time to invest? If David is predicting 10% rental growth and 5% capital growth, and Conor's only predicting a 2% increase in base rate, then I think this is definitely a time to buy. That's my view, and I agree. We've just done over an hour, which I think we did very well, and I've still got loads of questions we couldn't answer. So for everybody that attended, there will be a recording of this and it will be emailed out. Anybody with questions, they will be circulated and someone will come back to you, hopefully within the next day or so. If you need anybody's details or want to ask any questions urgently, you can email me, Marc with a C, and my name, marc@benhams.com, and I will circulate it to Conor, Chris, David, or Vanessa. Other than that, thank you very much for so many of you attending. Thank you to our amazing panel, Vanessa, Conor, Chris, and David. And we'll do another one of these coming up soon. And thank you very much to everybody for joining. Thank you. Thanks.